Welcome, and thank you everyone for joining us today. I'm Darcie Crowe, Senior Investment Advisor and Portfolio Manager at Canaccord Genuity Wealth Management. So I'm going to be hosting a variety of sessions over the coming weeks that are primarily going to be focused on alternative asset classes. This is a space that I've specialized in for over 10 years now, and I feel is an incredibly important allocation within portfolios. So I'm going to be highlighting some of the most impressive managers and product that I've uncovered over many years of due diligence in this space and share that information with you over the coming weeks. So alternatives have been a fundamental portfolio allocation for ultra high net worth clients, family offices, and institutions for many years now. And there's been heightened interest recently, given where we're at in the market cycle. So of course, there's been significant increase in volatility year to date related to COVID-19. We're now seeing record low interest rates. So fixed income's not as attractive as it once was. So investors are looking for lower volatility solutions, perhaps solutions that are uncorrelated to the market. So I'm very pleased to highlight some exemplary solutions to fill that gap. So with that, I would like to introduce our guest today. Greg Romundt is the founder and president of Centurion Asset Management. He has been investing in residential real estate since 1997, and he has real estate investment experience across the globe, including Singapore, Britain, Australia, China, and Canada. So Greg has an incredible track record of delivering results as president at Centurion. So Greg, thank you so much for joining us today. We're very grateful to have you here to share your insight with us.
Thank you very much for having me. It's great to be here.
Fantastic. Well, I think to start, not all of our viewers will be familiar with Centurion. So just wanted today to start with, if you can give us a bit of an overview of what Centurion Apartment REIT is and what you invest in.
Sure. An apartment REIT is a real estate investment trust, and our primary business is owning and operating apartment buildings, primarily in Canada. We have some in the United States, but also student housing.
Okay. Fantastic. So that's a great overview. And to dive a little bit more into industry, I know you wrote a pretty in-depth report a couple of months back and really went through the different types of industries within real estate and how they were affected throughout COVID-19. So obviously on the retail and hotel side, they were dramatically impacted, whereas things such as, multifamily and industrial were much more resilient. So if you could talk a little bit about what you went through in that report and what makes multifamily and student housing so defensive in nature.
Sure. So I'll start with multifamily. I mean, everyone needs to live somewhere, and during COVID, I mean, people focused on really two things. One was food and their housing, and the government in this particular time made sure that there was enough of both of those with the benefits they sent out to people. So multifamily has got a very long-term track record of producing positive returns. In fact, in the last 34 years, according to some in an index we watch on an unleveraged basis, apartments have actually never lost money. So, very, very stable asset class, because again, everyone needs to live somewhere. When you talk about student housing, student housing tends to be somewhat negatively correlated to the economy. We have Canada's kind of chosen to be a destination for foreign students. It's a deliberate strategy. So, and our universities have been growing to accommodate that. It tends to be when the economy is slow, people stay an extra year in school or do an extra degree. So we think it is counter-cyclical, although, this one is a rather odd recession. We can talk about that a little bit, but generally speaking, that's why student housing would be considered counter-cyclical and a good hedge for a little bit of economic uncertainty.
Yeah, no, that all makes very good sense. So I guess, speaking to COVID-19 and this economic recession a little bit more specifically. So maybe walk us through a little bit about what your experience has been throughout this period, this year throughout COVID, both in terms of, how has Centurion performed throughout this, and also maybe your, rent collection experience both on the multifamily and the student housing assets.
Sure. Well, we released our second quarter results a little while back, and if we didn't mention the word COVID, you probably wouldn't have noticed. Collections were almost normal. So if you look back at what we had for our April rent collection, we're at 99.6% collections rates overall. What I find interesting about that is, that's very close to what we would expect in a normal time. We always have some residents who don't pay for whatever reason. They lose their job, they get a divorce, they have to move, whatever it is. So we budget a certain percentage of rent, and that's about what we budget. Just like you'd budget for utilities cost or property taxes as part of your operating expense, we budget things like bad debt and collections risk. So the collections experience was excellent. In fact, I know that we did particularly well, but as an industry, the apartment industry did pretty well as well. We look at our second quarter results beyond collections, we continue to push our margins. So we saw a 2-point increase in our operating margin from almost 68 to almost 70%, which is a record high for that quarter on a quarter basis. So I think that's very strong. On residents that are turning over, we really do, in the markets that we operate, have a housing shortage. So we saw on apartments that turned over, quarter 2 2020 versus quarter 2 2019, the average in place rent on a turned over unit was up 19%. So that's what I mean. If we didn't mention COVID in the report, you probably wouldn't have noticed.
Yeah, no, it's amazing. And I mean, when we spoke to clients about your rent collection experience, I mean, people were blown away. It's quite amazing.
Yeah, no, it was good. I mean, we did work with residents. We did a couple of things. The first is, like most of the large landlords in the space, we agreed kind of as an industry, okay, we're not going to increase rents during the lockdowns. And, so that impacted rent increases during the quarter, but I mean, we'll recover those. And we just thought that was the right thing to do. The second thing we did was any of the residents that, had problems, we agreed to work with, right? And so we established payment plans, and very few people wanted to take a risk with their housing, right? Yeah. And COVID kind of just highlighted why you don't. Not only that, but people would normally might leave if they had an issue. They just didn't want to leave unless you had to. You didn't want to leave. So, yeah, it was much better than I think even the most optimistic of us in the industry. I don't think anticipated that it would have turned out as well as it did.
Yeah, no, absolutely. And what about on student housing? How is the experience?
So student housing is about 9% of the portfolio, and it performed less well, but still pretty well and well above expectations. And what we saw today, were normally at this time of year we would be 99% occupied. Maybe I think last fall we might have had, out of 3,000 units, we might have had 10 in the whole portfolio. So basically 99.9% occupied. This fall we're 85% occupied. We continue to lease, which is actually very interesting. Normally by September 1, everyone has found an apartment, they've moved in, and it's over for leasing, right? So if you're not full, well, you're going to have to wait for the next move-in cycle. And what we found was that the leasing, instead of being done in the spring, which is when much of it gets done, a lot of it got done this summer as students decided, okay, I've spent 6 months with my parents. I don't want to spend another year locked down with my parents. But, it's more than just desire. The fact is something like 42% of students don't have either adequate access at home to high-speed internet, which would make it appropriate for them to study at home, or they don't have a space that would allow them to study at home. So they might have, young siblings and stuff, or not a private bedroom, and it would make it very difficult for them to do their online classes. So we found a lot of students showed up. A lot have booked for January. So we think by January, we'll be at 95%. So almost a normal year. And which is really, really quite good. And students continue to show up at a fairly brisk pace, because I think as the schools have opened up, they see their friends or at least having some of the social experience of university, and university is not just academics, it's an experience, right? So they're seeing that, okay, it wasn't terrible, and it's more terrible to live at home or stay at home, and they're showing up. So I feel pretty optimistic that things will be fairly back to normal reasonably soon.
Okay, fantastic. So I know the fund had been closed to new capital for some time, and you've now opened it back up in the current landscape. So can you talk a little bit about the opportunities you're seeing today, both in Canada and the United States, and sort of what drove you to make that decision to open up and where you're putting that capital to work?
Okay. So, during, we went into the COVID period with quite a bit of capital. I mean, organizationally, we had almost over $400 million of both cash and lines available. So we were quite prepared. We also had a number of acquisitions we were doing, which we subsequently completed on. Our view was that the apartment industry would just come out of this as somewhat as normal, and it's ended up working out that way. But we knew that during this period where people weren't flying, if we're buying an apartment building and call it Vancouver or Victoria or Quebec or Nova Scotia, how do we get out? How do we get our teams there? So the industry, basically, everyone continued completing on the deals that they already had, but they stopped diligencing new transactions, and vendors thought, well, the worst time to try and sell something is when no one's willing to look.
Yeah.
And so no one, unless you had to, took a property to market, right? So it was very, very quiet. Now, so basically what we've got is 6 months of product that would have otherwise normally have come to the market in a normal year coming available. And we've got, I think, a normal September, and September is really when our business is probably the most active, between September, December, when people come back from holidays, because it tends to be an older demographic that owns a lot of the product in this space, and before they go off to Florida for the summer, for the winter. So we are seeing lots of opportunities in the apartment space. We're very much focused on the new construction space, because there's been a lot of apartments that are in construction. We think there's a lot of opportunity there. We're less focused today on the United States, because we think there's so much runway in Canada, and if you have to pick your best deals, you want to pick the deals where it's the tightest markets, and Canada has the tightest markets. There's not a lot of student to buy, because a lot of the best quality locations have been snapped up. Some is coming. We did manage to tie one student deal that was held by a foreign investor based in Asia, and I think they ran into a few problems, and we were able to get a pretty good deal. So we moved in.
Okay. And whereabouts are some of them? I think sometimes people are surprised by where a lot of your locations are. So some of the key areas that you're sort of looking at, just because I think people are usually surprised by where those are.
Okay, so we just completed a transaction in Quebec City. So that was a very large transaction. That was a $175 million deal for almost 700 units in Quebec City for a brand new Class A, best in class asset. We're very happy with that one. That was a deal we worked on for almost 9 months. Yeah. And we've got two deals currently under contract. One is that student deal I mentioned, and another one in brand new one in downtown Montreal. Okay. Other places where we've been fairly active is we've bought quite a bit of product in the greater Vancouver area. So Victoria, Langford, Surrey, we're focused on Burnaby, these kind of areas, because we think there's lots of opportunity there. We're playing really the theme we're playing, and this isn't just post-COVID. We've been playing this theme for a decade. We're always value players, so we've always bought in the suburbs and the exurbs, and today that's kind of actually, and I wrote about this it's one of the things. I think it's actually a very strong positive tailwind in the post-COVID era where people are moving out, particularly millennials, are moving out of downtown core areas to the suburbs where we've got product. So, we've also bought quite a bit in Alberta. We think that there's some good value in Edmonton, for value add and even for new opportunities.
Okay, fantastic. Well, that's great, and sounds like lots on the horizon. So it'll be interesting to follow that. So just wanted to touch on performance now. So from our experience, the fund has really delivered exceptional and stable, consistent performance. So can you just touch a little bit on what's the overview, how the fund's performed since inception? And then it would also be great, people always sort of wonder in this new climate that we're in now, what can you maybe expect over the near term, 12 to 24 months out?
Sure. So the last, this fund was set up in August of 2009, so about 11 years now. So since that time, it's about 13.5% compounded rate of return with no losing years. And then there was, this fund actually evolved from a limited partnership, which we founded in 2006 and eventually evolved into that. And if you include that whole period, we're about 16% compounded rate of return over that, I guess it would be 15 years now. We've got, last 3 years been exceptionally strong. So about 20% compounded rates of return. We're anticipating, fully that that's going to slow down. And for the next 12 to 15 months, we're probably in that, we always told people our targets were 7 to 12. We've always soundly outperformed that. I think the next 12 months, we're being very conservative, and we think we're going to be inside that range, probably on the lower end of it. I mean, be very happy with, high single digits. But, we think we have a lot of runway once the economy is somewhat normalized, because there are so many opportunities, and I've written quite extensively about this as well, that Canada is chronically short of apartments. I mean, we have underbuilt apartments for the last 50 to 60 years. And people's, with an aging population, with cost of housing, I really think that this is unprecedented. We've overbuilt condos and underbuilt apartments. And so there's a tremendous opportunity, and we've really designed our business to be able to take advantage of what we see is coming, and that is lots of brand new apartments. Yeah.
Okay. Well, I think that's a great segue into sort of the last question and how I wanted to leave things up. Well, and I think as you pointed to, that paper you wrote, I think really clearly laid out a lot of compelling, reasons, why Centurion is such a great opportunity today. But if you can just sort of summarize, why an investor would want to consider investing in Centurion today.
Look, I think we've performed very strongly with very limited risk. I mean, if you look at our the volatility of our fund versus the returns that we've provided, we're definitely top left. Volatility is on the order of government bond funds, and we've returned more than the S&P over a comparable time period. So to get comparable returns at a third of the volatility, I think is pretty good. We're virtually, I wouldn't say completely economically uncorrelated, but there's very low correlation between our returns and those of the markets. So I think we're a good fit for portfolios as a diversifier, provide a decent cash yield, which is mostly return of capital. So I think that's, there's some tax benefits. And really, I think you have to look at only the performance of the fund manager, and I think we've done a really good job. If I do pat myself on my own back, I think we've done a really great job. Our margins are top of the industry. But I think if you look at the performance of the apartment industry is one of the most economically secure sectors you can invest in. I think if you look at across the economy, like just ignore what stock prices are doing, right? Because you can have a long discussion about what stock prices are doing relative to what earnings are doing.
Yeah.
But if you look at what if you look at how our business performed as apartments, and I'm not just talking about us, but apartments in general, how apartments in general did compared to almost any other segment of the economy. And, apartments just came out on top. I mean, I think you'd be very hard pressed. I mean, I remember when I saw the results of some of the grocers like Loblaws come out and their results were down. I thought, how'd that happen? Right? Because you would have thought that they would have just crushed it. I'm not attacking them at all, but it's just apartments did exceptionally well. And there's very few comparables to that. And I think in any time you'd be happy to have apartments in your portfolio. I think in times where you've got economic volatility or lots of uncertainty, it's absolutely the thing you want in your portfolio.
Yeah. Okay. Well, thank you. That's incredibly insightful, and our clients have been very, very pleased to have it in the portfolio where they do. So thank you. I hope that gave our viewers some really great information with regards to Centurion, multi-asset real estate, as well as student housing as well. So again, please note these sessions are to be provided for information and are not considered a recommendation. So if you're interested in chatting further about Centurion, the multifamily space, alternative assets in general, and how that fits within your unique portfolio, I'd absolutely be pleased to do so with you. So that concludes our session today. So Greg, sincere thanks to you. I know you have a lot on your plate, so thank you so much for taking the time. And everyone, thank you for tuning in. And please we're going to have some upcoming sessions in which we're highlighting other best-in-class managers in other alternative spaces. So please look out for that as well. So thank you, Greg, and thank you, everyone, and have a wonderful day.
Thank you so much. Bye now.
Thank you. Bye-bye. Take care.